We're going to go ahead and finish the journal entry for Jason Sawmill in his 4th year. Before we do that though, I'm just going to go ahead and label this a letter A so it corresponds to the letters in our general ledger. And now I'm ready to record annual amortization on the sawmill. We have a rate of $50,000 per year. So debit amortization expense, credit accumulated amortization sawmill, and that's a journal entry all done. So we're now going to post from a journal entry into our general ledger. So beginning balance for accumulated amortization sawmill, we're going to have 3 years of it, and that's going to be $150,000 that we calculated earlier. This year will be another 50,000, right? That's our credit from up here, and we'll have our ending balance. Remember, $, double underline of $200,000. Moving over to amortization expense. Now, as we're going to see in the next chapter, everything that's on the income statement ends up being closed at the end of the reporting period. So typically at year end, you close everything. So despite what the amortization expense would have been for all capital assets inside this company, we're going to start the year with 0 because everything closes to 0. So we're going to kind of ignore the amortization of the other assets. We're just looking at the sawmill right now. So we're just going to have this as $50,000 debit coming from up here. So naturally we would have our trucks and equipment also as amortization expense, but we're going to ignore that for now and just assume this is the only asset we're amortizing. And we have ending balance on December 31st of $50,000 in amortization expense. So as I mentioned, this will be a temporary account which will get closed off, and we're going to see that in the next chapter. Note that our amortization expense T account starts from 0 each reporting period, but the accumulated amortization account carries its balance from period to period as long as we hold the relevant asset. Another important point is the amortization expense for a given period may be a result of several capital accounts being amortized. So in this case, sawmill, equipment, and trucks, while the accumulated amortization account is reserved for only specific assets or asset classes. Right, so it's a contra account which is specific to one asset. And as I mentioned, with our amortization expense T account, we kind of ignored the other two assets, which Jason would amortize under normal circumstances. Accrued expense is an expense which has been incurred, but the payment isn't due until later. In other words, the firm has not yet received a bill or invoice to signal the payable. Accrued expense is always a liability. A common accrued expense is salary. Imagine that the bookstore owes $1,200 to its employee at the end of the quarter. It is the weekend and the paycheck will be handed to the employee on Monday, does an adjusting entry need to be made? Of course it does. The balance sheet should reflect all liabilities on the date shown at the top. So the question is, how do we make a journal entry to reflect this liability? The answer is we create a payable account. Similar to accounts payable, salary payable depicts a small liability which will be settled in the near future. In our example, the bookstore would make the following entry. So take a minute here and try this, and we will go over this journal entry in 30 seconds in the same video. So we're just taking the number from up top. The amount that we owe to our employee is $1,200. We'll plug it in as a debit for salary expense and as a credit for salary payable. And of course, the description is to accrue salary expense. The salary expense would be shown on the bookstore's income statement and the salary payable in the liabilities section of its balance sheet. Now let's try an entry where the bookstore pays the employee for salary a few days later. So from June 30th, when we recorded this liability, to July 2nd, when we pay off this liability. Take a minute here and try this journal entry, and we will cover it in just a minute here in the same video. First thing we're going to do, we're going to reverse our liability, which shows up as a credit in the journal entry just above this one. So debit salary payable to get rid of that credit balance because it is now paid. And of course, whenever we pay an employee, we pay with cash. So we'll credit 1,200 as cash. And we'll write a brief description here. I'm just going to write down paid, owed, salary to employee. Accrued revenue. It is similar to an accrued expense, except in this scenario, revenue has been earned, but cash has not been collected. Consider the bookstore paying a laptop for a student, but deciding to bill his account later. If the quarter end occurs before the billing happens, the bookstore must make an adjusting entry to reflect the sale. So this journal entry is all done. Note that it's the end of the quarter on June 30th. And note that we have a debit to accounts receivable and a credit to service revenue. So this is no different from performing a service on account. That's essentially what it is. You've done a service, somebody owes you money, so you make this adjusting entry at the end of the quarter to ensure that revenue is recognized in the quarter it should be recognized. Right? You don't want it to split over to next quarter because this quarter is actually when you did the work. All accrued revenue transactions have the same structure. A receivable is debited and a revenue account, usually sales or service revenue, is credited. Unearned/deferred revenue. In this case, cash is collected from a customer, but the promised sale or service has not yet been fulfilled. This is a liability that the business has to fulfill to earn the cash already paid. Imagine the bookstore collected cash from a student prior to ordering in a particular textbook. So the idea is the student pays us to order in a book and sell that book to her, but we don't have the book in stock. So we take the cash and we wait for the book to come to the bookstore. So we collect cash, $150, and then we credit unearned sales revenue for $150. And that's advance payment for textbook collected. When the book arrives and the student comes to the bookstore to pick up her book, we make another entry to record the completion of the sale. So I'll give you a minute to do that, and we will go over the journal entry in just a minute in the same video. Once again, we're going to undo the liability, which was recognized earlier. So you have unearned sales revenue, which was a credit, will now be debited to get rid of it. And we'll have a debit of 150. And now we've actually done everything that was asked of us to make the sale of the textbook. So we can recognize the sales revenue. In this next quarter, which is a couple days later, on July 2nd, and just write down a brief description. Book sale completed. There are also a couple of journal entries which need to be made with regard to the bookstore's addition of the textbook to its inventory and subsequent subtraction or sale from its inventory. We will ignore that element for now. To wrap up this chapter, let's have a look at the trial balance again. Now it's an adjusted trial balance. So I mentioned in the last chapter that the trial balance itself would not be on your exam, but an adjusted trial balance is fair game because you're provided with the trial balance and you make some adjustments and you end up with the adjusted trial balance. So making adjustments and calculating the adjusted trial balance, that's a skill that is still relevant in today's accounting industry. So let's have another look at that same trial balance we looked at in the last set of notes. We have the SFU bookstore. Now it's called the adjusted trial balance in thousands of dollars. And the date is March 31st, 2018. So we have, looking at the second column, we have a bunch of adjustments happening here, right? So we have three transactions, A, B, and C. And what they do is they adjust the unadjusted trial balance over here. So when you look across, you say cash, there's no adjustment, so it remains 165 in our third and final column. But accounts receivable, there is an adjustment. So it's a 35 debit unadjusted, and a $5 debit adjustment gives us 40, right? So that's kind of what's happening here. I'm going to scroll down a little bit so you can observe the bottom. We have totals, right? So we're verifying debits equal credits, 450 and 450, just like last time. Our adjustments add up to 21 and 21. And our adjusted trial balance ends up adding up to 471 and 471. That confirmed that we probably did everything correctly as we added across. Now, before I go further, let's actually look at what the adjusting entries were. A was accrued rent expense of $10,000 recognized for the quarter. So, having a look at A, we have a debit to rent expense, as we would expect, of 10, standing for 10,000. Of course, it's in thousands of dollars. And then we have account payable of 10,000 also. So we incurred a rent expense, but we haven't paid our landlord yet. So we have a debit to rent expense and a credit to account payable. We have quarterly amortization expense of 6,000 recorded. So we just covered amortization earlier in this chapter. We have amortization expense as a debit for 6 and accumulated depreciation as a credit for 6. Of course, I'm a little bit low on space here, so I didn't label which asset it belonged to, but according to good accounting practice, we really should, right? It could belong to a couple of things. It could belong to furniture, or it could belong to equipment. We don't know which one, so I really should have done that. Accrued service revenue of $5,000 recorded. That's transaction C. So as we would expect, we have accounts receivable. Someone owes us money. That's our debit, and we have a credit of 5 to service revenue. So we've done some work, and we recognize it in the current quarter. So adding across should be straightforward. I encourage you to try it. But that's your adjusted trial balance to wrap up this chapter. So we'll be moving on to chapter 4. But before you do that, remember to try the chapter 3 quiz and also submit your homework. Thank you.